Hi, Mark Anderson here, mortgage banker with Paramount Bank. I am licensed to lend in all 50 states, and I would love the opportunity to earn your business. Please do call or text me anytime at the number below. For today's mortgage rate update, I'm going to lead with an observation that the mortgage bond market today was not really very interesting. Nothing really changed in terms of rate sheets today, at least for me. We've got a ton of different correspondent lenders that we have access to, and really the rate sheets remained pretty much the same all day. The mortgage bond market in terms of pricing, this is a 2-day view of the bond market. We closed yesterday, let's see, right around here at this 103.69 level, which again is lower than that 104 level that was sustained toward the end of last week. Today we opened higher. Typically, that's what happens in the morning because the Fed bond buying activity starts early and continues in this case up until, well, you can always see it because there's a drop when the Fed stops buying bonds. So it looks like that dropped off right here. But overall, as dramatic as this might look, we ended the day yesterday at this 103.68, 103.67 level, and we ended today right exactly there. So from a market mover standpoint, did the mortgage bonds move the market today? No. But I thought it would be interesting and important to bring up another aspect of some elements that drive mortgage rates. So part of the reason why I started doing these videos is I wanted to correct some, let's say, myths and some misunderstandings as far as how mortgage rates are derived, what impacts mortgage rates, the role of mortgage bonds in determining mortgage rates on a day-to-day basis. One of the myths that I want to correct is maybe not a myth, but it's an overgeneralization. And the myth goes something like this. When the economy is bad or having a hard time, mortgage rates go down, okay? That's correct in this case. It was this virus and concerns about it that caused the stock market to have some really bad days, to have some huge losses. There was a flight from money in stocks to money in bonds because bonds are seen as a safer investment. That caused bond prices to go up. That caused mortgage rates to drop. So bad things scare the economy. The economy adjusts, moves money around, moves money into bonds, makes mortgage rates better. Okay, I'm good there so far. This line of thinking is motivating a lot of people's thinking as it comes to their decisions about whether or not to lock in their interest rate. I've talked to a number of people, and I'm not going to say that any of these people are wrong, but in my estimation, I think the chances that they are right is low. The line goes something like, well, I think things will continue to get worse in the economy. Therefore, because we know when things get bad in the economy, mortgage rates get better. Because we know that, I think things are going to get worse, and therefore, mortgage rates are going to go lower. I don't think that has a high probability at all of working out that way. Just because on the one hand, one of those things is true, that when the economy first ran into trouble, that there was money that moved from stocks into bonds, which made mortgage rates better. Just because that is true does not mean that the economy getting worse further is going to somehow make rates better or lower than they are now. And here's why I feel confident in saying that. The only reason that we're seeing the mortgage bond prices that we are right now is that we have the Federal Reserve pumping a truly insane amount of money into the market. If the Federal Reserve was not putting money into the bond market right now, there's no way we would see bond price levels where we're at right now. I want to remind people of a time, let's see, back here, this is the 3-month. So this is that point, March the 6th, when rates got really, really good. Bond prices fell down like a rock here just 6 days later. They fell into another trough here on the 19th. That caused rates. I mean, I don't know if anybody remembers this, but that caused rates to come up to, with 4s in front of them for 30-year fixed rate products. And then this is when the Federal Reserve started dumping money into the mortgage bond market. So the line of logic goes, well, I think the economy is going to get worse and therefore mortgage rates are going to get better. Well, here's what worse looks like in the economy right now. Number one, worse in the economy looks like people not making their mortgage payments. Worse in the economy looks like greater unemployment. Do either of those things help mortgage bond prices? Do either of those things influence lenders to make their mortgage rates better? I don't think so. I really, really don't think so. If anything, one of the things that we're seeing right now in the market is, and I'm going to go back to, gosh darn it, let's go to the 3-month view. I've made this point before, but this really bears repeating. We're seeing bond price levels over the past few weeks that are significantly higher than the bond prices that we reached back when the rates first dropped. They dropped to their lowest point here back in early March. Bond prices are higher at this phase right here, and the mortgage rates are not lower. Well, why are they not lower? I've gone over this a couple times, but one of the reasons that they're not lower is that the investors that are purchasing these mortgages have increased their margins. Well, a lot of people may assume that this is greedy banks that are increasing their margins and taking advantage of the economy. And I don't know, maybe that's true to a degree. I don't know. I'm not here to make a value judgment. But maybe they're increasing their margins because they've got a lot of loans that are on their books that they're responsible for collecting the payments on, that are part of their servicing portfolios. They've got a lot of loans that are not going to be paid on. And this is not good. Now, I'm not asking anybody to feel any sympathy for stockholders or board members of banks. I know that would be a very difficult task to try to evoke some sympathy for those folks. But that's not what I'm here to say. What I'm here to say is the argument went, well, I think the economy is going to get worse, therefore mortgage rates are going to get better. Well, what worse looks like right now does not, in my mind, make mortgage rates better. Again, the only thing holding the mortgage bond market where it's at right now is the Federal Reserve. And if things do get worse, what worse looks like is more people losing their jobs, more people not making their payments. Does that make it more likely that the end mortgage investors are going to reduce their mortgage rates on new loans for refinances? I just don't see it. I just don't see it at all. Now, I think that we may see some cyclical phenomenon here that's repeated a past phenomenon like I talked about in my last video, where there is certainly a chance that we're going to see rates come back down by a little bit. And again, they're up by just a hair today versus where they were at the end of last week. The change is not huge. But I guess I just wanted to kind of talk through that, because I think, yes, it is true. When this all first happened here back in March, the economy got scared, moved money out of stocks into bonds, and made mortgage rates better. So that line of logic is true. But getting worse is not the same thing at this point. It's not going to trigger the same phenomenon. And so I don't personally see why the economy getting worse is going to make mortgage rates better at this point. And I've talked way too long at this point, but those are my thoughts for today. Thank you very much. I think this was probably very rambling and quite possibly at least slightly incoherent, but I hope that I made my point. I'm happy to kind of sharpen this up a little bit in future videos. But those are my thoughts for today. I would be happy to look at any of your individual scenarios to talk with you about your refinance options, your purchase mortgage options. Please do like the video, subscribe to the channel, share the video, and please throw a comment in and let's have a conversation. I'm interested to hear your thoughts about everything. Thank you very much.